is it really a change coincident with the weakness in the dollars? Foreigners are finding a whole world now of things to park their money in rather than just recycling it in U.S. assets, which they will continue to do. But on the margin, if they do it a little less so, that means that you can have further weakness in the dollar and other assets can benefit relative to U.S. assets.
Welcome back to Metals and Miners. I'm your host, Gary Bohm. Today, we're diving deep into the dynamic world of market trends, investment strategies, and economic forecasts. I'm thrilled to introduce Peter Boockvar, Chief Investment Officer of 1 Point BFG Wealth Partners, and he's also the editor of the Boock Report on Substack. With a wealth of experience as a market strategist and commentator, Peter is actually very celebrated for his keen insights, pragmatic approach, and ability to decode complex economic signals across commodities, equities, and global markets. And those are the things we're diving into today. Peter, it's an honor to have you back on Metals and Miners. Welcome to the show.
Thanks, Gary. I appreciate those kind words. And for viewers who, just a heads up, the new firm is not a new firm. It's just a new name, rebranding, so that there's no confusion there.
Appreciate you sharing that. All right, Peter, let's begin with the administration's pivot away from the austerity attempt all the way now into the NASCAR level growth attempt. President Trump signed the big, beautiful bill into law. By various rating measures, it adds 4 to 7 trillion to the debt over 10 years. So about another 500 billion or so annual increase to the already 2 to 2.5 trillion annual deficits. Deficit spending is clearly here to stay, and it's being doubled down on. Our debt to GDP ratio is well over 120, last seen around World War II. That's typically danger territory. Their plan to lowering that is unleashing the higher growth. As long as growth as a percentage of GDP is higher than debt, the ratio should come down. What could go wrong with this plan?
Well, a couple things to that. So I'm not a fan of the CBO scoring the extension of existing tax rates as sort of an incremental deprivation of tax revenue to the federal government. And that is helping to drive, call it the $4 trillion number. What the administration is trying to do, and keeping in mind that debts and deficits will continue to rise, but what they're trying to do is they're trying to front load the growth aspects of the bill. Again, extending tax cuts, or I should say extending existing tax rates, is not incremental stimulus. It is not. The only growth aspect of the bill was on the tax side in terms of the incentives given to companies to invest via immediate expensing on R&D, plant and equipment, machinery, and so on. That's the stimulus part. The question offsetting that is, what are the tariffs going to be as an offset? In terms of spending cuts, or actually it's not really cuts, it's just slowing the pace of spending increases. That really doesn't start until 2027, when the administration is almost out the door, where the Medicaid job requirements or work requirements start to kick in, and which could have an impact on at least the Medicaid spend. But we know that the major parts of the budget are really being untouched. Now, on the discretionary side, maybe I think we'll see a little slower rate of increase in spend, but I think net $2 trillion plus deficits is something is here, and none of these numbers take into account a potential economic downturn or recession, which would then lead to a double-digit budget deficit relative to GDP. The point is that when you go into this with a 6.5% to 7% deficit, there's no room for error. None whatsoever.
Yeah, and that's the troublesome part. But so everything has to just operate moving forward perfectly to plan, and we'll be okay. Otherwise, there's going to be some negative impacts, correct?
And even just going to plan still maintains that deficit. It's called 6.5% to 7%. So there's nothing in this I see that would actually reduce that ratio. because that's the goal, right? Is to grow faster to reduce that ratio. And I don't see really anything here that's going to get us to grow faster that would reduce it. At best, it stays the same.
So, I don't want to put words in your mouth, but it sounds like there is some, when you look at it, you see some troublesome signs there.
Well, I would have liked to have seen spending cuts start now rather than kicking the can down another 2 years. Now, from the administration standpoint, they understand if you slow down the pace of government spending, you're going to have a negative effect on economic activity.
Exactly.
Because government spending has been a major boost to to economic activity over the last couple of years. In fact, one of only 3 areas of contributors to economic growth, with weakness in many other places.
Yeah. Okay, so we have this K-shaped economy. Everybody's been talking about that for the last couple of years, where the top 10%, they spend almost 70% of the consumer spending. It's somewhere in that 65, 70% range. They own most of the assets. As long as their asset base is growing, they continue to spend. They get that wealth effect. They feel wealthier, but they could only spend so much on travel, leisure, fun, toys, etc. The rest goes into assets. As the K-shaped economy favors them more and more, they make more and more, but they could only spend so much. So that excess does get put into the assets. It's driving assets higher. Markets are at highs. Gold's at highs. Real estate's at highs. Many of the assets are at highs, and other assets are now rising. Do you expect that paradigm to continue for the foreseeable future?
Well, what you're basically saying, and I agree with this, is that you cannot disconnect the economy from the S&P 500. Basically, they're linked, they're tied at the hip. That and this whole debate about over the last couple of years, are the rate increase is going to lead to a recession or not? A big part of that debate was, okay, I need your opinion on the S&P. If you thought that the markets would still do okay under that circumstance, that would reduce the odds of a recession. If you were of the belief that the stock market was going to get negatively hurt by the rise in interest rates outside of what we saw in 2022, then that would increase the odds of a recession, because you cannot disconnect. And that really started with Greenspan when asset prices became part of his whole wealth effect concept. But also to your point that you can only spend so much. Yes, that's true. Someone whose 401k is going up every day, but they're only 40 years old, they're not spending their 401k. They can only spend to the extent at which their income comes in minus their expenses. So yes, there are some limits. There's no question. But outside of, I mentioned government spending being a huge boost to economic growth, that high income spending also has been a main contributor, in addition to anything related to the AI build out. Everything else in the U.S. economy is at best flatlining, and as a worst is in a recession.
Yeah. Okay. All right. So despite, Peter, what we just discussed, assets rising, the people on the bottom of the K-shaped economy, they're struggling still. Those who don't own assets, they've seen the things that they need for everyday life get and stay more expensive, and they're paying for them with fiat dollars that are losing purchasing power. We see credit card balances and delinquencies rising. We see more and more consumers, even those who earn a good salary, they're living paycheck to paycheck. Student loans, they're now once again needing to be repaid, adding some confusion to the budget, personal budget into the mix. The consumer on the bottom part of the K has a lot being thrown at them. The big, beautiful bill, as discussed earlier, is more of the same. It's doubling down, implying more pain for the bottom of the K. Your thoughts?
Well, the bottom of the K got a very small little chip when they passed the no tax on tips and overtime, but that only has an income threshold of $25,000. So yes, it'll help people a little bit, but not too much. You're right with this differential and bifurcated consumer. In fact, the University of Michigan Confidence a week ago actually highlighted it, that those that own stocks feel better about their outlook than those that do not. And you also see that I go through a lot of earnings calls, and you hear from companies themselves making a clear distinction amongst their customers. And Coca-Cola even, they're selling a product that costs $1, highlighting the differential in spend between most of their customers and the lower income consumer. I mean, it's to the point where, and I heard this from Conagra, which is a stock we own, unfortunately, because it hasn't done well, but they have a snacks business. And, snacking for a low income consumer is a discretionary decision. And with many consumers focused on just affording the non discretionary stuff in their lives, in other words, paying for the needs rather than the wants, that thing of beef jerky, which Conagra sells, is not necessarily going to be purchased when that low income consumer goes to the mini mart to get gasoline. So that tells you a lot about that low income consumer. They're stretched, but that's that's the environment we're in, unfortunately. And it also creeps into the middle income. I mean, Chipotle, which has killed it for years, even talked about softening in their business when they reported earnings this week, and the stock traded down in response. So there's a lot of fragility to the economy, certainly for the consumer, but the upper income consumer, no doubt doing better than everybody below them. Also benefiting too, and I'll add, it's not just the stock portfolio, the value of their home on average is up 50%, 50 over the past 5 years.
So I have a question next about home sales, but I did see a article recently where it said more and more people who are earning even as much as $250,000 a year are living paycheck to paycheck because of the scenario that you described.
Well, certainly if you're living in New York, California,
right? And with the bottom of the K, it seems like more. It's going to be more of the same for the bottom of the K. That means there's going to be more people caught on the margins with delinquencies and other problems.
Yes, and the key thing to watch from here going forward is what's happening also in the labor market. On one hand, the pace of firings is still rather muted. We're seeing that in jobless claims. There is tightness in the labor market. We heard that from Robert Half this week, which is a staffing company. But on the other hand, CEOs, employers are very reluctant to add much staff. And whether that is because of tariffs or just general economic cloudiness in terms of visibility, there is a notable slowdown in the pace of hirings. So for that incremental person looking for a job, it's going to get tougher. And I'll tell you who's actually negatively affected right now, and I'm seeing this firsthand, are the college graduates who just left school and are looking for a job. They're actually having a tough time finding that first job because of this slowdown in hiring, where if you're going to hire somebody because you have to, it'll be more like an experienced person rather than fresh out of school.
Yeah. Those are all great points. And, I just interviewed Steve Brown, who's a former exec at Google DeepMind, and it was a very illuminating conversation. And it's quite possible that right now there's a lot of people sitting in the boardroom saying, yeah, we could use people, but how could we deploy AI instead?
Well, it's interesting. They are having that discussion, there's no doubt. You had the Shopify CEO, I think it was last quarter, that said to any possible new employee, convince us that AI will do your job for you, which was an interesting challenge. But I still think it's very early in terms of the usage of AI replacing jobs. Speaking of Robert Half, and I recommend anybody watching this to go through their earnings transcript. Again, this is a staffing company. If there's a business that's going to get disrupted, it's possibly AI to Robert Half, because if AI can do people's jobs, then there'll be less need for staffing. So Robert Half was actually asked this question, and they did their own deep dive internally and looked at, there's this World Trade Organization list, I think it's the WTO, list of the most vulnerable jobs to AI when looking at over the next couple of years. And they're not seeing it yet. Now, yet is the key word. Things are going to change here, but nothing yet that is disrupting the labor market in some of the areas that you think would get disrupted, like data center, like call centers, for example, or something. Now, it's probably coming, but of course, the hope is that technology always creates new jobs that you don't think about. I'm hoping to be the case, but that also ties into, if AI, which is a great tool that people are going to integrate into their business, if it is not this transformative thing like some people think, well, what about the hundreds of billions of dollars that these hyperscalers are spending investing in it? what happens if they don't get the return on this that everyone is hoping for? I mean, Google just raised their CapEx for the year to 85 billion from 75 billion. It is a whopping 25% of their revenues. I mean, these used to be cash flow generating high margin businesses, and now they've become very capital intensive businesses. So this is all of an interesting interrelated exercise, because if the AI trade is lost, well, then that goes into its effect on the stock market, which can then flow through consumer spending and so on. So everything is intertwined here.
Yeah, I totally agree. And the Trump administration, I think it was 2 days ago, released their AI action plan. It was very detailed. And with action plans, they didn't just summarize what their plan, what they're focused on, but they also added, steps that they're going to be taking. So it looks like they're fully mobilizing behind this. According to Steve, it's not going to take but just over the next couple of years, and every company on the globe is going to be integrating AI in some capacity into their operations. He was talking about hallucinations within the the large language model outputs that are still being worked on, but he said they're becoming less and less. He fully expects, based on everything, all the people he's talking to from inside Google and the other places, that we're not that far away from every company on earth beginning to make that transition. But
no doubt. I mean, just like with any piece of software, it's going to get integrated into our daily lives. I guess the question is to what extent and what the disruption it causes.
Yeah, I would highly recommend everybody listening to go check out that Steve Brown interview. It was just a couple of days ago. He's the former executive for Google DeepMind. It was very intriguing. All right, so Peter, home sales in the U.S., they're weak. They're at levels not seen in decades. Mortgage rates holding strong in the high 6, low 7% range. Insurance, property taxes up across the board. Same with HOA fees and home maintenance costs. Home ownership is really at unaffordable levels for so many, and it goes way beyond the last housing crisis. It's really not been at this level, if ever, but a very long time. We're seeing house price softening in about 50% of the markets in the U.S., but nothing yet substantial enough to bring equilibrium to the market and to start driving the sales engine. Interestingly, I just saw it today. You might have seen it. New home prices are dropping while existing home prices are actually rising. It's created a chasm of about $30,000 where new home prices are $30,000 cheaper than existing home. That's never really happened before. That can't and won't continue. What do you see coming for the real estate market and prices? And do you expect mean level home price affordability versus mean level income earning to come back into equilibrium at some point soon?
Well, one of the reasons for that differential, at least for the large home builders, is they're still relying heavily on incentives to move product. When you think about an existing home, it's already been built. The new home builder is having to deal with a continued rise in the cost of construction. And now with tariffs on aluminum and lumber and copper and steel, building that home is even more expensive. But because they're discounting in order to push product because of those affordability challenges, there is that widening gap. The thing that needs to happen in the housing market is, there's this very simplistic thought that, the Fed needs to cut interest rates and mortgage rates will fall and the housing market will get stimulated. Well, if there's any lesson we learned over the last 20 years, is artificially low interest rates only pushes demand. It doesn't magically create new supply. Now, there is supply that tries to meet that demand, but if demand runs faster than supply, all you do is get a price increase that offsets the benefit of lower mortgage costs. So it's amazing that people continue to spin, mortgage rates need to go down, that's going to solve our problem. No, you need an increase in supply that comes coincident with a decline in mortgage rates. And what will bring that extra supply? Well, there's not enough new home supply. And right now there's actually too much and we're seeing the discounting because certain markets are slowing down. But big picture, at this point, we really need the baby boomers to downsize. That's where over the next 10 years, more existing home supply is likely to come from. That is a That's not soon enough for many first-time home buyers that can't afford to buy a house, because the price of a home is up, as I said earlier, on average 50% over the past 5 years, and you have almost a 7% mortgage rate. And it's the combination that makes buying a home today as expensive or more expensive than it was in the early 80s when mortgage rates were like 12, 13, 14%.
So, okay, so reading between the lines of what you just said, you're expecting this unequilibrium environment to persist for a while.
Until we get a lot more supply across the board, this market, unfortunately, is going to remain relatively frozen. Frozen is defined as the pace of existing home sales being the lowest since 1995 at about 4 million homes annualized. And obviously, we have a much bigger population today than we had then.
So outside of an unemployment event, what unsticks this market? Just a lot of inventory coming on, people wanting to sell, prices dropping.
I think you need baby boomers to downsize. You need them to give up their single family home that they've owned for the past, call it 40 years, and you need them to move into the townhouse or into the condo.
Okay. All right. Well, that's what we'll be watching for. All right. So Peter, the U.S. debt's about 37 trillion. It's racing towards 50 trillion, much higher. Unfunded liabilities over 100 trillion. Austerity nowhere to be found. The dollar's value is relentlessly being stripped of purchasing power. Foreign nations on the margins are buying less of our growing debt pile. What is the case for foreign nations to buy U.S. debt, guaranteeing that the purchasing power loss of the reserves when it matures? I mean, doesn't the Fed have to augment this fiscal dominance with printing at some point? Give us a picture of the bond market and whatnot.
Well, the Treasury market its complexion in terms of ownership has certainly changed over the last 10 plus years, where more than 10 years ago, foreigners owned about half of the U.S. Treasury market. They've continued to buy over the last decade, but that ratio is now down to 30%. So the U.S. government has had to rely more and more on domestic purchasers. One of those, of course, was the Fed that sort of filled the gap from foreigners. I think foreigners will continue to reduce that allocation to treasuries. And if they do buy treasuries, it's going to be more and more just T-bills because they can get a good rate of return on T-bills and they don't have to take much duration risk. Yes, they'll take sort of inflation risk in terms of the purchasing power of their money when they get it back when their bond matures, but it's a much better deal than if they bought 5, 10, 30-year government paper. And what the U.S. Scott Bessent and Trump are basically telling you, we're going to give you as many T-bills as you want because that's where they're going to be front loading a lot of the issuance away from the long end because they're afraid that long end rates continue to head higher. But I do think that foreigners have shown this year that there are other alternatives to U.S. stocks, bonds being both treasuries and corporates. And look at the performance of international markets this year. After what was seemingly forever underperformance, foreign markets are crushing the U.S. market this year, and even more so when you take into account the weakness in the dollar. So I think foreigners have realized that they have other places to put their money. Emerging market bonds have done very well also. And if you're going to buy a T-bill, maybe you'll buy short-term German bunds instead of U.S. treasuries, where the debt to GDP ratio there, while rising because of the fiscal spend they're doing, is only about 65% instead of 120% here. So I think that was really a change coincident with the weakness in the dollars. Foreigners are finding a whole world now of things to park their money in rather than just recycling it in U.S. assets, which they will continue to do. But on the margin, if they do it a little less so, that means that you can have further weakness in the dollar and other assets can benefit relative to U.S. assets.
Yeah, I totally agree. And one of the things you didn't mention there was gold, but gold has definitely increased as a
Gold's
percentage.
a beneficiary, definitely, of that shifting flow pattern of foreign money.
Yeah, I believe it passed the euro just recently as well as a percentage holding. So the U.S. has something like on the order of 16 trillion in bonds maturing over the next 18 to 24 months. Most of the average yield on that is under 2%. While rates are over 4% currently, debt servicing costs have already risen in the last several years from about 350 billion to now over $1 trillion. If interest rates stay at current levels, the annual debt servicing the U.S. faces is going to rise to between 1.5 to 2 trillion, all things being equal. They already run the deficit of over 2 trillion, like you mentioned earlier. It kind of sounds like a debt doom loop scenario when you put it that way. Are interest rates guaranteed, in a sense, to come down one way or another over the coming months to ensure debt rollover occurs at yields of no higher than the 2%?
Well, short rates will if the Fed cuts rates, and we know the U.S. government is going to rely more on short-term issuance. Long-term interest rates, I believe, are going to continue to go higher. And I think it really depends on where on the yield curve the U.S. government is going to try to be. But because of that interest rate risk, they are going to continue to issue more on the shorter end, hoping that the next Fed chair, not until next May, though, will help them out. Until then, maybe we'll get another 50 basis points of cuts. But the reliance on the short end is gonna do their bidding right now. But we know that is potentially a big problem down the road, because if you get another inflation flare up and the Fed has to raise interest rates, just imagine that again, then the U.S. government is really toasted with respect to the interest expense they're going to have to pay.
Yeah, goodness, that's a scary proposition right there. So let's say, as you put it, that the new Fed chair is going to help them out. What happens to real things, precious metals, commodities in that type of low interest rate environment?
If it's low artificially, it's low. If it's low because it's been pressed there, as opposed to having more of an equilibrium relative to the rate of inflation, well, then that's a problem for the dollar, and that's good for any hard asset. As we've seen in the past when we had negative real interest rates. There was a time pre-2007 when the average real rate was about 200 basis points. So if the inflation rate was 2, Fed funds rate would be 4-ish. Well, core inflation is around 3. So even with the Fed funds rate of 4.33, the effective rate, this is where the Fed funds should be. So if they start pushing it down because the president wants them to, and you start to get real rates that are trending close to zero, where in Europe they're back to zero crazily, and in Switzerland they're actually even negative in Switzerland. Well, then you get a bid to hard assets and a loss to the value of the U.S. dollar.
Is that the scenario you're expecting as a base case?
I am, but I think this time long rates are going to speak for themselves too, and long rates are going to sort of punish the Fed for doing that, and which will then in turn reduce the ability of the Fed to do what Trump wants them to do.
Yeah. Okay. So all of these developments that we've talked about, and the continual exponential usage of AI and robotics, plus the electrification of everything that you could think of, requires historical levels of metals to be able to function. Mining the metals out of the ground, Peter, you know this, it takes a long time and a lot of capital. It could take as long as 10 to 20 years to get a mine to become a producing mine of substantial quantities. So a historic level of capital should have been invested years ago to meet tomorrow's metals needs that is coming, that's projected, but that just hasn't happened. Everybody's been investing in Nvidia, Microsoft, Apple. They've forgotten essentially about the metals. Some metals like silver have been in a supply deficit already for years. Others are close to entering a supply deficit. And this is all before this massive demand is set to hit. How much of a bottleneck, in your opinion, to AI, robotics, data center, and electrification, the evolution of all those things, do you expect the metals to become at some point?
Well, we're definitely beginning to see it on the electricity output side in the U.S. I think it was PGM, which is the regional electric utility grid for 12 or 13 different states, that just announced a notable increase in their power auction, which is now getting some of these state governors to actually investigate this. We're reaching bottlenecks, and that's because the demand certainly is overwhelming the incremental supply that was completely, a few years ago, probably couldn't even understand what Gen AI was, let alone plan in a 5 to 10 year basis what the power demands would be. I mean, this is really just a rush in late 22, early 2023, and these are long-lived projects. So a couple of years ago, this wasn't in any electric utility's budget. And then, of course, as you talk about getting this stuff out of the ground, just a few years ago, this wasn't in anybody's sort of forecast either. Was this big ramp up in the demand for power? And unfortunately, you can't just snap your finger and get these metals out of the ground to create the genesis of this power. And that is going to lead, I believe, to continued high prices for these industrial metals. I mean, and much higher than what we see now. I mean, silver at $40 is kind of funny in a way that we've seen gold go to almost 3,500 and silver still below where it was 14 years ago.
It's really wild.
At its peak.
So do you, aside from the prices, elevating, I don't want to say spiking, but elevating, do you foresee them becoming a bottleneck to the actual growth and expansion of AI, robotics? Do you think it'll stunt their growth in a sense?
I don't. It's hard to say. Theoretically, I would say yes. That there's just, you talked about deficits. There's deficit in platinum as well. This will be the second year in a row.
Projected in lithium in, I think, 27. Copper.
Lithium is more easier to access. It's not as rare as some of these other things, but there could be temporarily. I don't know enough about the sort of scrap that some companies are going to be able to rely on, particularly copper and silver, to sort of fill that gap. But yeah, we're setting ourselves up for potential bottlenecks. There's no question, which would slow the pace. But I mean, look at rare earths and the magnets and the magnets that they go into. Just by China cutting off the delivery of them caused a ruckus for a lot of companies. That you want to talk about a bottleneck. Now, this was self-imposed bottleneck by China, but Ford basically had to stop production lines until the magnets came into their factory.
It also forced a pivot by our government. So
correct. We are now shipping H20 chips to them in return for those rare earths.
Yeah, I mean, it was that extreme. So that's a great point. All right. So gold and silver miners, they're up 50 to 60% this year. Yet there's really still not a ton of care and attention being paid to them at all. I mean, I don't want to say they're non-existent, but it's just relative to, their performance and what's coming and how much cash flow they're generating. It's like ghost town. Investors are still interested in so many other assets at the moment. Gold miners, they're making money hand over fist. And now that silver is rising the way it is, silver miners are beginning to join the cash flow party. As long as metal prices stay where they are or go higher and energy prices stay muted the way they have, it really seems like the perfect cocktail for the miners right now, which is greatly needed for the reasons we've been talking about. Do you expect to see the miners to not only continue to perform well, but for the investing crowd to begin making their way over to the sector due to, what we've laid out here?
I do think they'll continue to do well, but what investors need after many, many years of disappointment is they need to see quarter after quarter after quarter of some consistency in generating strong growth. Nothing is worse than seeing ever higher prices for your finished product and your business not being able to take advantage of it. And that seems to epitomize the mining business over the past 25 years, where we've had ever higher and higher gold prices, but miners continuously seem to have fumbled the ball. Now it seems like they're actually holding tight to the ball. It seems like there's a lot of running room with the ball, but from the generalist investor standpoint, they feel like they've been burned so many times that, hey, why should I bother? I can just buy the sexiness of this AI trade instead of, the tough, rough and tumble business of getting stuff out of the ground that's really difficult to do. But investors and human nature being what they are, a couple more quarters of very robust profit and free cash flow growth, you can be sure that investors are finally going to come around to it, even though they've already started to. But that's what investors will do. They'll come to it after it's already worked, drive it even further higher, which then we can then sell to them before something changes.
Yeah, I think you make a great point. Well, this has been a wonderful discussion. I want to welcome everyone who's tuning into this fantastic interview with Peter Boockvar, Chief Investment Officer of One Point BFG Wealth Partners, and he's also the editor of the Book Report on Substack. Before we wrap up here with our final set of questions, I just want to direct everyone who's interested in the metals and mining sector to just dive into our Substack at metalsandminers.substack.com. Join the quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. It's also the title of the report. I'm also positive that you've been enjoying this conversation that I've been having with Peter as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video. Peter, before we started recording, we talked about an asset lightning round. I'm going to ask you to rank some assets 1 to 100, 100 being an extreme buy, 1 being an extreme sell, and then just give 1 to 2 sentences as to why you take the position. We'll try to roll through these real quick. All right. So on a scale of 1 to 100, is gold right now a buy or a sell, and why?
I would say, well, I think it goes higher. I think a lot. I'm going to give it a 90. I'll give silver though 100.
Physical silver.
Physical silver, gold 90, because I think there's more upside in silver from here.
Okay.
Even though both can easily double from current levels.
Okay. Gold miners 1 to 100.
I'm going to go with 100 too. I mean that the GDX used as an example of an ETF. It's lower than when it was in 2011 when gold was 1900. Now, granted, costs have gone up a lot, so it's not apples to apples what I'm telling you, but I think it's a sign that there's also a lot of upside there as well.
All right, silver miners.
I would similar. I mean, all of those are, call it 90 to 100s.
Okay, copper 1 to 100, and why?
I'm going to lessen this to maybe 75. On one hand, we know where the demand drivers are, but I still think you have that economic sensitivity that's flowing through this. U.S. growth in the first half of this year is 1% on average. So that's the only reason why I discount that a bit.
Okay, so it sounds like you're still toying with the idea of a potential recession.
Yes,
okay.
Tariff-induced, self-imposed recession.
All right, 1 to 10, 10 being the highest probability. What's the likelihood of a recession?
So, as I said, if the Atlanta Fed is right and GDP growth is 2.5% in Q2, if you average that with the minus 0.5% in Q1, that is 1% growth. And the tariffs still are working their way through the economy. Tariffs don't just disappear. $450 billion of taxes doesn't just disappear. Most of it's getting eaten by us. And therefore, I think that is a potential further dampener on growth in the second half of the year. Then, of course, where the stock market goes from here is going to sort of determine whether that tips us over into recession or not. But
sounds like you might have a greater than 50% probability, though.
I'm going to say that there's a 65% probability because of these tariffs.
Okay. All right, let's move over to energy. Start with uranium, 1 to 100, buy or sell, and why?
So we've been bullish on uranium. I'm going to say that's an 80, not because uranium and nuclear is not a great story, but the price moves. We're not early innings anymore on these price moves.
Yeah. Now, do you make a distinction between the metal and the miners with uranium?
Yeah, somewhat. Mining is still a challenging business if you're in that business. So there is some distinction. Now, in nuclear, you can play it through actually owning reactors and facilities and sort of picks and shovels, and then you can actually own the uranium. I prefer just owning the uranium, which seems like an easier decision.
So maybe like SPUT, SPUT?
Yeah, exactly.
Yeah, okay. All right, oil, 1 to 100, and why?
I'm giving this 100. $65 oil is dirt cheap. The interesting thing is we had, I think, our fourth increase in quotas from OPEC, and we haven't seen a big incremental increase in actual supply from them. That maybe the quota changes were really just moving in line with where current production already was, which tells me that the market is possibly tight. Also, the U.S. oil rig count, the crude oil rig count in the U.S.,
down a lot.
In terms of low prices, curing low prices, is down for 13 weeks in a row. I just saw it today, down another 7 rigs. We're down more than 60 rigs. We're at the lowest level since 2021. So I think it's 2020. I have to confirm, or mid 2022. But we're at a multi-year low in the level of oil rigs. So $65 dirt cheap, particularly on an inflation-adjusted basis. So I'm very bullish on crude oil and also natural gas. So I'm giving 100 to both of them.
Okay, let's move over to the general markets. We'll do the S&P.
S&P, it's with it continuously being driven by this AI tech trade, which clearly has gotten a second wind. Can this keep on going? Yes. Are the risks rising tremendously? For sure. You're trading at 24 times earnings now. Just to give you an idea, in March 2000, on a forward 12-month basis, we were trading at 24 and a half times earnings. We are in rarefied air in terms of valuations with 1% GDP growth. There's a major disconnect. A lot of times there is. Stock market's not the market. The market's not the stock market. I'm sorry. The market's not the economy. The economy's not the market. And if there's any time that epitomizes that, it's right now.
It kind of makes me think about, who Michael Green is, and he talks about this issue about basically the, everything's on autopilot coming through the 401ks and whatnot right into the market. And then from that, it's like, it's going to go into this mutual fund, that mutual fund. And so as long as we don't have an unemployment event, that's going to likely to continue, correct?
It will. But, Michael's a friend and he's a genius on this. Flows go where things work. And the stock market has worked for the last 15 years outside of, the short pullback with the pandemic and with tariffs. So money is going to continue to flow when things work. When things stop working, well, then that money flow is going to slow.
Yeah.
So that's my belief on passive. I work at a wealth management firm. I see those flows every single day. And I will tell you that if the market rolled over and didn't have this V-shaped recovery that we're so used to seeing, then that money is going to flow less. So I think a lot we'll have to do is weather this perpetual bull market that's shortly interrupted by V-bottoms. If it keeps going and keeps working, well, yeah, the passive bid's going to continue to go there. So
do you subscribe to the idea that when it stops working, we're going to see a rotation into real thing?
When it stops working, the money's going to come out. And also with baby boomers, 10,000 turning 65 every day. Now, granted, you need to be 72, 73 to get your required minimum distribution out of your 401k. But every day, somebody's qualifying at that age, taking money out of the market. Now, they can reinvest it, but there's money coming out that they got to pay a tax on. And if they reinvest the balance, there's less money coming in than coming out. So there is an impact that people that passive trade should understand, is that money every day is coming out of the market via those RMD distributions.
Yeah. Okay. Did you give a 1 to 100 score on the S&P? I forget.
So I'm going to have to give this like a 30.
Okay.
To be honest,
That's fine.
Keep on going. No doubt about it. And I'm done with picking targets and having big calls in the market, but we're stretching the rubber bands here in a major way, I believe.
All right. The NASDAQ.
Same thing.
30. Same reasons. All right. What about treasuries? Short-term treasuries.
T-bills. I'd be buying T-bills all day.
So 100 on that?
100 on T-bills and a 0 on the 10-year. 0. Or maybe a 20. I'll give it some credit.
All right. 1 to 10% inflation ending 2025.
I think inflation is going to be around 3-ish by the end of the year. You have services deflation now for the next couple of quarters because of rental growth slowdown. But on the other hand, goods prices are now inflecting higher because of tariffs. But next year, I think more importantly, 3.5. The days of sustainably staying around the 2 level, I think are over for the next couple of years. And there's a big difference between 3 and 2 because that has a major influence on monetary policy and long end bonds.
Do you expect them to change their policy from 2% to 3%?
No.
Okay. All right. So finally, the recommended portfolio allocation for decades has been this 60-40, 40% bonds, 60% stocks. Really has been no mention of precious metals whatsoever. What's your recommended precious metals allocation, and which bucket or buckets are you pulling from?
Well, luckily we did make an allocation, which helped us, and the bucket we pulled it out of, outside of the portfolios I manage, broadly speaking, we pulled it out of fixed income. And fixed income has obviously had, or at least in the treasury market on the duration side, it's had a terrible couple of years. So gold has crushed owning fixed income.
Okay. Do you have a recommended allocation? Is it?
I mean, I know the rule of thumb is 5 to 10%, which for the average person I would say yes. For a portfolio that I run, it's probably north of 20. But for that average conservative person, 10%
Minimum
is a decent amount, give or take.
Yeah. Okay. Appreciate that. So, Peter, would we're concluding here. Would you share a key takeaway that you want to leave with everybody here? It could be today's economic, market, monetary situation, anything that you really want to express to everybody. And then after that, let everyone know where they could learn more about your work, where they could find you and connect with you.
I think big picture, 2025, things have begun to change. I think that the foreign flow of money into U.S. markets is now finding other places. I think the Mag 7 trade is splintering. While these are all great companies, it's not 7 stocks that are dominating anymore. It's really more NVIDIA, Microsoft. We'll see if Google has staying power here, even though they did report a really good quarter. Apple's dropped out, Tesla's dropped out. I think the market performance overseas has proven that the pendulum is beginning to swing in the other direction in terms of flows. I think the bond bear market continues on. I think this dollar weakness this year is not just a half-year blip, that over a multi-year time frame, the dollar will continue to weaken, particularly against the price of gold. I think the tariffs have pissed off the rest of the world. Whether you agree with them or not, that's how it's looked at. And foreigners are going to find other places to invest. Yes, the U.S. will be very attractive. Yes, flows will still come here, but less so. And I do think that investors finally actually have a broader array of things to buy. And it's not just 7 stocks anymore.
Yeah, that's an interesting take. All right. Well, let everyone know how they can connect with you, where they could find your work, et cetera.
So on the wealth management side, our new website, onepointbfg.com, they can learn about our services there. And then on my macroeconomic and market commentary, I'm on Substack, Peter Boockvar. They can find me. It's called the Book Report, and hear what I have to say every day.
And you're also on Twitter.
Twitter, yes.
Okay, great. All right. Well, I'll have all the information up there. I always enjoy talking with you. I love our conversations and discussions. Thanks for being so generous with your time and your analysis. I look forward to having you back on sometime soon, Peter. Everybody else, thanks for watching.
Gary. Appreciate having me on.
A wonderful discussion. I want to welcome everyone who's tuning into this fantastic interview with Peter Boockvar, Chief Investment Officer of 1 Point BFG Wealth Partners, and he's also the editor of the Book Report on Substack. Before we wrap up here with our final set of questions, I just want to direct everyone who's interested in the metals and mining sector to just dive into our Substack at metalsandminers.substack.com. Join the quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. It's also the title of the report.